Market Wizards, Conversations with America's Top Traders, Jack D. Schwager, Harbor Business, You've Got to Learn How to Fall Before You Learn to Fly. One man's ceiling is another man's floor. If I wanted to become a tramp, I would seek information and advice from the most successful tramp I could find. If I wanted to become a failure, I would seek advice from men who had never succeeded. If I wanted to succeed in all things, I would look around me for those who are succeeding and do as they have done. As quoted in A Treasury of Wall Street Wisdom, edited by Harry D. Schultz and Samson Koslow. Preface: there are some amazing stories here. A trader who, after wiping out several times early in his career, turned a $30,000 account into $80 million. A fund manager who achieved what many thought impossible 5 consecutive years of triple-digit percentage returns. A trader from small-town America who started out on a shoestring and has become one of the world's largest bond traders, a former securities analyst who, during the past 7 years, has realized an average monthly return of 25% over 1,400% annualized, primarily trading stock index futures, and electrical engineering graduate, from whose largely computerized approach to trading has earned his accounts an astounding 250,000% return over a 16-year period. These are but a sampling of the interviews contained in this book. In his own way, each of the traders interviewed has achieved incredible success. What sets these traders apart? Most people think that winning in the markets has something to do with finding the secret formula. The truth is that any common denominator among the traders I interviewed had more to do with attitude than approach. Some of the traders use fundamental analysis exclusively, others employ only technical analysis, and still others combine the two. Some traders operate on a time horizon measured in hours or even minutes, while others typically implement positions that they intend to hold for months or even years. Although the trading methodologies varied widely, the forthcoming interviews reveal certain important commonalities in trading, attitudes, and principles. Trading provides one of the last great frontiers of opportunity in our economy. It is one of the very few ways in which an individual can start with a relatively small bankroll and actually become a multimillionaire. Of course, only a handful of individuals, such as those interviewed here, succeed in turning this feat, but at least the opportunity exists. While I hardly expect all readers of this book to transform themselves into super traders, the world just doesn't work that way. I believe that these thought-provoking interviews will help most serious and open-minded readers improve their personal trading performance. It may even help a select few become super traders. Jack T. Schwager, Golden's Bridge, NY, May 1989. Part 5. Acknowledgments. First and foremost, I would like to thank Stephen Kronowitz, who pored over every chapter in this book and provided a multitude of helpful suggestions and editing changes. I am indebted to Steve for both the quantity hours and quality of his input. They were simply stimulants to make the Earthlings perform vividly for the crowds at the zoo, to make them jump up and down and cheer, or gloat, or sulk, or tear their hair, to be scared shitless, or to feel as contented as babies in their mother's arms. The Earthlings did very well on paper. That was part of the rigging, of course. And religion got mixed up in it, too. The news ticker reminded them that the President of the United States had declared National Prayer Week and that everybody should pray. The Earthlings had had a bad week on the market before that. They had lost a small fortune in olive oil futures. So they gave praying a whirl. It worked. Olive oil went up. Slaughterhouse 5. If the random walk theorists are correct, then earthbound traders are suffering from the same delusions as the zoo inhabitants of Kilgore Trout's novel. Kilgore Trout is the ubiquitous science fiction writer in Kurt Vonnegut's novels. Whereas the prisoners on Zirconminus 212 thought their decisions were being based on actual price quotes, they were not real-life traders believe they can beat the market by their acumen or skill. If markets are truly efficient and random in every time span, then these traders are attributing their success or failure to their own skills or shortcomings, when in reality it is all a matter of luck. After interviewing the traders for this book, it is hard to believe this view of the world. One comes away with a strong belief that it is highly unlikely that some traders can win with such consistency over vast numbers of trades and many years. Of course, given enough traders, some will come out ahead even after a long period of time, simply as a consequence of the laws of probability. I leave it for the mathematicians to determine the odds of traders winning by the magnitude and duration that those interviewed here have. Incidentally, the traders themselves have not a glimmer of doubt that, over the long run, the question of who wins and who loses is determined by skill, not luck. I, too, share this conviction. 7. My own story. Right out of graduate school, I landed a job as a commodity research analyst. I was pleasantly surprised to find that my economic and statistical analysis correctly predicted a number of major commodity price moves. It was not long thereafter that the thought of trading came to mind. The only problem was that my department generally did not permit analysts to trade. I discussed my frustration over this situation with Michael Marcus' first interview, with whom I became friends while interviewing for the research position he was vacating. Michael said, "You know, I had the same problem when I worked there. You should do what I did, open an account at another firm." He introduced me to a broker at his new firm who was willing to open the account. At the time I was earning less than the department secretary, so I didn't exactly have much risk capital. I had my brother open a $2,000 account for which I acted as an advisor. Since the account had to be kept secret, I could not call in any orders from my desk. Every time I wanted to initiate or liquidate a position, I had to take the elevator to the building's basement to use the public phone. Marcus' solution to the same problem is discussed in his interview. The worst part of the situation was not merely the delays in order entry, which were often nerve-wracking, but the fact that I had to be very circumspect about the number of times I left my desk. Sometimes I would decide to delay an order until the following morning in order to avoid rearing any suspicion. I don't remember any specifics about my first few trades. All I recall is that, on balance, I did only a little better than break even after paying commissions. Then came the first trade that made a lasting impression. I had done a very detailed analysis of the cotton market throughout the entire post-World War period. I discovered that, because of a variety of government support programs, only 2 seasons since 1953 could truly be termed free markets in which prices were determined by supply and demand rather than the prevailing government program. I correctly concluded that only these 2 seasons could be used in forecasting prices. Unfortunately, I failed to reach the more significant conclusion that existing data were insufficient to permit a meaningful market analysis. Based on a comparison with these 2 seasons, I inferred that cotton prices, which were then trading at 25 cents per pound, would move higher but peak around 32–33 cents. The initial part of the forecast proved correct as cotton prices edged higher over a period of months. Then the Advance accelerated and cotton jumped from 28 to 31 cents in a single week. This latest rally was attributed to some news I consider rather unimportant. Close enough to my projected top, I thought, and I decided to go short. Thereafter, the market moved slightly higher and then quickly broke back to the 29-cent level. This seemed perfectly natural to me, as I expected markets to conform to my analysis. My profits and elation were short-lived, however, as cotton prices soon rebounded to new highs and then moved unrelentingly higher: 32 cents, 33 cents, 34 cents, 35 cents. Finally, with my account equity wiped out, I was forced to liquidate the position. Not having much money in those days may have been one of my luckiest breaks, since cotton eventually soared to an incredible level of 99 cents, more than double the century's previous high price. That trade knocked me out of the box for a while. Over the next few years, I again tried my hand at trading a couple of times. In each instance, I started with not much more than $2,000 and eventually wiped out because of a single large loss. My only consolation was that the amounts I lost were relatively small. Two things finally broke this pattern of failure. First, I met Steve Kronovitz. At the time, I was the commodity research director at Hornblower and Weeks, and I hired Steve to fill a slot as the department's precious metals analyst. Steve and I shared the same office, and we quickly became good friends. In contrast to myself, a pure fundamental analyst, Steve's approach to the markets was strictly technical. The fundamental analyst uses economic data to forecast prices, while the technical analyst employs internal market data such as price, volume, and sentiment to project prices. Until that time, I had viewed technical analysis with great skepticism. I tended to doubt that anything as simple as chart reading could be of any value. Working closely with Steve, however, I began to notice that his market calls were often right. Eventually, I became convinced that my initial assessment of technical analysis was wrong. I realized that, at least for myself, fundamental analysis alone was insufficient for successful trading. I also needed to incorporate technical analysis for the timing of trades. The second key element that finally put me into the winners column was the realization that risk control was absolutely essential to successful trading. I decided that I would never again allow myself to lose everything on a single trade, no matter how convinced I was of my market view. Ironically, the trade that I consider my turning point and one of my best trades ever was actually a loss. At the time, the Deutschmark had carved out a lengthy trading range following an extended decline. Based on my market analysis, I believed that the Deutschmark was forming an important price base. I went long within that consolidation, simultaneously placing a good till canceled stop order just below the recent low. I reasoned that if I was right, the market should not fall to new lows. Several days later, the market started falling and I was stopped out of my position at a small loss. The great thing was that after I was stopped out, the market plummeted like a stone. In the past, this type of trade would have wiped me out. Instead, I suffered only a minor loss. Not long thereafter, I became bullish on the Japanese yen, which had formed a technically bullish consolidation, providing a meaningful close point to place a protective stop. While I normally implemented only a one contract position, the fact that I felt reasonably able to define my risk at only 15 ticks per contract today, I find it hard to believe that I was able to get away with that close a stop allowed me to put on a 3-contract position. The market never looked back. Although I ended up getting out of that position far too early, I held one of the contracts long enough to triple my small account size. That was the start of my success at trading. Over the next few years, the synthesis of technical and fundamental analysis combined with risk control allowed me to build my small stake into well over $100,000. Then the streak ended. I found myself trading more impulsively, failing to follow the rules I had learned. In retrospect, I believe I had just become too cocky. In particular, I remember a losing trade in soybeans. Instead of taking my loss when the market moved against me, I was so convinced that the decline was a reaction in a bull market that I substantially increased my position. The mistake was compounded by taking this action in front of an important government crop report. The report came out bearish, and my equity took a dramatic decline. In a matter of days, I had surrendered over 1/4 of my cumulative profits. After cashing in my chips to buy a house and later taking a year-long sabbatical to write a book, my savings were sufficiently depleted to defer my reentry into trading for nearly 5 years. When I began trading again, typical to my usual custom, I started with a small amount, $8,000. Most of this money was lost over the course of a year. I added another $8,000 to the account, and after some further moderate setbacks, eventually scored a few big winning trades. Within about 2 years, I had once again built my trading account up to over $100,000. I subsequently stalled out, and during the past year, my account equity has fluctuated below this peak. Although, objectively, my trading has been successful on an emotional level, I often view it with a sense of failure. Basically, I feel that given my market knowledge and experience, I should have done better. Why, I ask myself, have I been able to multiply a sub-dollar 10,000 account more than tenfold on 2 occasions, yet unable to expand the equity much beyond that level, let alone by any multiples? A desire to find the answers was one of my motivations for writing this book. I wanted to ask those traders who had already succeeded, what are the key elements to your success? What approach do you use in the markets? What trading rules do you adhere to? What were your own early trading experiences? What advice would you give to other traders? While, on one level, my search for answers was a personal quest to help surpass my own barriers, in a broader sense I saw myself as everyman, asking the questions I thought others would ask if given the opportunity. Jack D. Schwager, A Complete Guide to the Futures Markets, John Wiley & Sons, New York, NY, 1984. Part I, Futures and Currencies. 10. Taking the mystery out of futures. Of all the markets discussed in this book, the futures market is probably the one least understood by most investors. It is also one of the fastest growing. Trading volume in futures has expanded more than 20-fold during the past 20 years. In 1988, the dollar value of all futures contracts traded in the U.S. exceeded $10 trillion. Obviously, there is a lot more than pork belly trading involved here. Today's futures markets encompass all of the world's major market groups, interest rates, e.g. T-bonds, stock indexes, e.g. the S&P 500, currencies, e.g. Japanese yen, precious metals, e.g. gold, energy, e.g. crude oil, and agricultural commodities, e.g. corn. Although the futures markets had their origins in agricultural commodities, this sector now accounts for only about 1/5 of total futures trading. During the past decade, the introduction and spectacular growth of many new contracts has resulted in the financial type markets, currencies, interest rate instruments, and stock indexes accounting for approximately 60%. This is a rough but conservative estimate based on 246 million contracts traded and assuming an average contract value well over $40,000. Excluding short-term interest rate futures such as Eurodollars, single contract values ranged from about $11,000 for sugar at zero to $150,000 for the S&P 500 at an index value of 300. Of all futures trading, energy and metal markets account for nearly half of the remaining 40%. Thus, while the term commodities is often used to refer to the futures markets, it has increasingly become a misnomer. Many of the most actively traded futures markets, such as those in the financial instruments, are not truly commodities, while many commodity markets have no corresponding futures markets. The essence of a futures market is in its name. Trading involves a standardized contract for a commodity, such as gold, or a financial instrument, such as T-bonds, for a future delivery date as opposed to the present time. For example, if an automobile manufacturer needs copper for current operations, it will buy its materials directly from a producer. If, however, the same manufacturer was concerned that copper prices would be much higher in 6 months, it could approximately lock in its costs at that time by buying copper futures now. This offset of future price risk is called a hedge. If copper prices climbed during the interim, the profit on the futures hedge would approximately offset the higher cost of copper at the time of actual purchase. Of course, if copper prices declined instead, the futures hedge would result in a loss, but the manufacturer would end up buying its copper at lower levels than it was willing to lock in, while hedgers, such as the above automobile manufacturer, participate in futures markets to reduce the risk of an adverse price move. Traders participate in an effort to profit from anticipated price changes. In fact, many traders will prefer the futures markets over their cash counterparts as trading vehicles for a variety of reasons. 1. Standardized contracts. Futures contracts are standardized in terms of quantity and quality. Thus, the trader does not have to find a specific buyer or seller in order to initiate or liquidate a position. 2. Liquidity. All of the major futures markets provide excellent liquidity. 3. Ease of going short. To the futures markets allow equal ease of going short as well as long. For example, the short seller in the stock market who is actually borrowing stock to sell must wait for an uptick before initiating a position. No such restriction exists in the futures markets. 4. Leverage. Of the futures markets offer tremendous leverage. Roughly speaking, initial margin requirements are usually equal to 5 to 10% of the contract value. The use of the term margin in the futures market is unfortunate because it leads to tremendous confusion with the concept of margins in stocks. In the futures markets, margins do not imply partial payments, since no actual physical transaction occurs until the expiration date. Rather, margins are basically good faith deposits. Although high leverage is one of the attributes of futures markets, for traders it should be emphasized that leverage is a two-edged sword. The undisciplined use of leverage is the single most important reason why most traders lose money in the futures markets. In general, futures prices are no more volatile than the underlying cash prices or, for that matter, many stocks. The high-risk reputation of futures is largely a consequence of the leverage factor. 5. Low transaction costs. Futures markets provide very low transaction costs. For example, it is far less expensive for a stock portfolio manager to reduce market exposure by selling the equivalent dollar amount of stock index futures contracts than by selling individual stocks. 6. Ease of offset. A futures position can be offset at any time during market hours, providing prices are not locked at limit up or limit down. Some futures markets specify daily maximum price changes. In cases in which free market forces would normally seek an equilibrium price outside the range of boundaries implied by price limits, the market will simply move to the limit and virtually cease to trade. 7. Guaranteed by exchange of the futures, trader does not have to be concerned about the financial stability of the person on the other side of the trade. All futures transactions are guaranteed by the clearinghouse of the exchange. Since by their very structure, futures are closely tied to their underlying markets, the activity of arbitrageurs ensures that deviations are relatively minor and short-lived. Price moves in futures will very closely parallel those in the corresponding cash markets. Keeping in mind that the majority of futures trading activity is concentrated in financial instruments, many futures traders are, in reality, traders in stocks, bonds, and currencies. In this context, the comments of futures traders interviewed in the following chapters have direct relevance even to investors who have never ventured beyond stocks and bonds. The interbank currency market defined. The interbank currency market is a 24-hour market which literally follows the sun around the world, moving from banking centers in the US to Australia, to the Far East, to Europe, and finally back to the US. The market exists to fill the need of companies to hedge exchange risk in a world of rapidly fluctuating currency values. For example, if a Japanese electronics manufacturer negotiates an export sale of stereo equipment to the US with payment in dollars to be received 6 months hence, that manufacturer is vulnerable to a depreciation of the dollar versus the yen during the interim. If the manufacturer wants to assure a fixed price in the local currency yen in 11. order to lock in a profit, he can hedge himself by selling the equivalent amount of US dollars in the interbank market for the anticipated date of payment. The banks will quote the manufacturer an exchange rate for the precise amount required for the specific future date. Speculators trade in the interbank currency market in an effort to profit from their expectations regarding shifts in exchange rates. For example, a speculator who anticipated a decline in the British pound against the dollar would simply sell forward British pounds. All transactions in the interbank market are denominated in US dollars. A speculator who expected the British pound to decline versus the Japanese yen would buy a specific dollar amount of Japanese yen and sell an equivalent dollar amount of British pounds. 12. Michael Marcus blighting never strikes twice. Michael Marcus began his career as a commodity research analyst for a major brokerage house. His near compulsive attraction to trading led him to abandon his salaried position to pursue full-time trading. After a brief, almost comical stint as a floor trader, he went to work for Commodities Corporation, a firm that hired professional traders to trade the company's own funds. Marcus became one of their most successful traders. In a number of years, his profits exceeded the combined total profit of all the other traders. Over a 10-year period, he multiplied his company account by an incredible 2,500-fold. I first met Marcus the day I joined Reynolds Securities as a futures research analyst. Marcus had accepted a similar job at a competing firm, and I was assuming the position he had just vacated. In those early years in both our careers, we met regularly, although I usually found my own analysis more persuasive when we disagreed. Marcus ultimately proved right about the direction of the market. Eventually, Marcus accepted a job as a trader, became very successful, and moved out to the West Coast. When I first conceived the idea for this book, Marcus was high on my list of interview candidates. Marcus' initial response to my request was agreeable, but not firm. Several weeks later, he declined as his desire to maintain anonymity dominated his natural inclination to participate in endeavor he found appealing. Marcus knew and respected many of the other traders I was interviewing. I was very disappointed because Marcus is one of the finest traders I have been privileged to know. Fortunately, some additional persuasion by a mutual friend helped change his mind. When I met Marcus for this interview, it had been 7 years since we had last seen each other. The interview was conducted in Marcus' home, a two-house complex set on a cliff overlooking a private beach in Southern California. You enter the complex through a massive gate, amazing gate as described by an assistant who provided me with driving directions that would probably have a good chance of holding up through a Panzer Division attack. On first greeting, Marcus seemed aloof, almost withdrawn. This quiet side of Marcus' personality makes his description of his short-lived attempt to be a floor trader particularly striking. He became animated, however, as soon as he began talking about his trading experiences. Our conversation focused on his early roller coaster years, which he considered to be the most interesting of his career. How did you first get interested in trading futures? I was something of a scholar. In 1969, I graduated from Johns Hopkins, Phi Beta Kappa, near the top of my class. I had a PhD fellowship in psychology at Clark University and fully expected to live the life of a professor. Through a mutual friend, I met this fellow named John, who claimed he could double my money every 2 weeks, like clockwork. That sounded very appealing. He laughs. I don't think I even asked John how he could do it. It was such an attractive idea that I didn't want to spoil things by finding out too many facts. I was afraid I would get cold feet. Weren't you skeptical? Didn't he sound too much like a used car salesman? No, I had never invested in anything, and I was very naive. I hired John, who was a junior at my school, to be my commodity trading advisor at $30 a week. Occasionally I threw in free potato chips and soda. He had a theory that you could subsist on that diet. That's all you paid him. Weren't there any profit incentives, extra potato chips, if he did well? No. How much money did you allot for trading? About $1,000 that I had saved up. Then what happened? My first trip to a brokerage house was very, very exciting. I got dressed up, putting on my only suit, and we went to the Reynolds Securities office in Baltimore. It was a big, posh office, suggesting a lot of old money. There was mahogany all over the place, and a hushed, reverential tone permeated the office. It was all very impressive. The focal point was a big commodity board at the front of the office, the kind that clicked the old-fashioned way. It was really exciting to hear the click, click, click. They had a gallery from which the traders could watch the board, but it was so far away that we had to use binoculars to see the prices. That was also very exciting because it was just like watching a horse race. My first realization that things might become a little scary was when a voice came over the loudspeaker, recommending the purchase of soybean meal. I looked at John, expecting to see an expression of confidence and assurance on his face. Instead, he looked at me and asked, "Do you think we should do it?" He laughs. It quickly dawned on me that John didn't know anything at all. I remember soybean meal was trading quietly 78.3 thousand, 78 4,000, 78.30 78.40. We put the order in, and as soon as we got the confirmation back, almost mystically, the prices started clicking down. As soon as it knew that I was in, the market took that as a signal to start descending. I guess I had good instincts even then, because I immediately said to John, "We're not doing too well. Let's get out." We lost about $100 on that trade. The next trade was in corn, and the same thing happened. John asked me whether we should do the trade. I said, "Well, all right, let's try calm." The outcome was the same. Did you know anything at all about what you were doing? Had you read anything about commodities or trading? No, nothing. Did you even know the contract sizes? No, we didn't. Did you know how much it was costing you per tick? Yes. 13. Apparently, that was about the only thing you knew. Right. Our next trade in wheat didn't work either. After that, we went back to corn and that trade worked out better. It took us 3 days to lose our money. We were measuring success by the number of days it took us to lose. Were you always getting out after about a $100 loss? Yes, although one trade lost almost $200, 1 cent was down to about $500 when John came up with an idea that was going to save the day. We would buy August pork bellies and sell February pork bellies because the spread was wider than the carrying charges, the total cost of taking delivery in August, storing, and relivering in February. Said we couldn't lose on that trade. I vaguely understood the idea and agreed to the trade. That was the first time we decided to go out to lunch. All the other times we had been too busy scrutinizing the board, but we thought this was a can't-lose trade, so it was safe to leave. By the time we came back, I was just about wiped out. I remember this feeling of shock, dismay, and incredulity. I will never forget the image of John. He was a very portly guy with thick, opaque glasses going up to the board, pounding and shaking his fist at it, and shouting, "Doesn't anyone want to make a guarantee profit?" Later on, I learned that August pork bellies were not deliverable against the February contract. The logic of the trade was flawed in the first place. Had John ever traded before? No. So where did he come up with this story about doubling your money every 2 weeks? I don't know, but after that trade I was wiped out. So I told John that, in light of what happened, I thought I knew as much as he did, which was nothing, and that I was going to fire him. No more potato chips, no more diet soda. I'll never forget his response. He told me, "You are making the greatest mistake of your life." I asked him what he was going to do. He said, "I am going to Bermuda to wash dishes to make a trading stake. Then I am going to become a millionaire and retire." The thing that amused me was that he didn't say, "I'm going to Bermuda and take a job to make a trading stake." He was very specific. He was going to wash dishes to get his trading stake. What eventually happened to John, to this day, I have no idea. For all I know, he might owe living in Bermuda as a millionaire because he washed dishes. After that, I managed to rustle up another $500 and placed a few silver trades. I wiped out that stake as well. My first 8 trades, 5 with John and 3 on my own, were all losers. Did the thought ever enter your mind that maybe trading was not for you? No. I had always done well at school, so I figured it was just a question of getting the knack of it. My father, who died when I was 15, had left $3,000 in life insurance, which I decided to cash in despite my mother's objections. But I knew I really needed to learn something before trading again. I read Chester Keltner's books on wheat and soybeans, and I also subscribed to his market letter, which made trading recommendations. I followed the first, recommendation, which was to buy wheat, and it worked. I think I made 4 cents per bushel, $200 on that trade. It was my first win and very exciting. Then, between letters, the market fell back to my original buying price, so I bought it again and made another profit on my own. I felt I was beginning to develop a sense for trading. Even in the beginning, I liked the feeling of doing things on my own. What happened next was just sheer luck. I bought 3 contracts of December corn in the summer of 1970, based on a Keltner recommendation. That was the summer that blight devastated the corn crop. Was that your first big win? Yes, that trade combined with buying some more calm wheat and soybeans, partly on recommendations in the letter and partly on my own intuition. When that glorious summer was over, I had accumulated $30,000, a princely sum to me, having come from a middle-class family. I thought it was the best thing in the world. How did you decide when to take profits? I took some on the way up and some when the markets started coming down. Overall, I cashed in very well. So instinctively you were doing the right thing even then? Yes. Then that fall I attended graduate school in Worcester, Massachusetts, but I found that I didn't want to think about my thesis. Instead of going to class, I would often sneak down to the Payne Weber office in Worcester to trade. I was having a great time. I made a little money, not a lot. I was shocked to find myself cutting classes, frequently since I had been a dedicated scholar at Johns Hopkins. I realized that the handwriting was on the wall, and in December 19,000, 701 dropped out of school and moved to New York. I stayed at the Y for a while. When people asked me what I did, I rather pompously told them that I was a speculator. It had a nice ring to it. In the spring of 1971, the grains started getting interesting again. There was a theory around that the blight had wintered over, that is, it had survived the winter and was going to attack the corn crop again. I decided I would be really positioned for the blight this time. Was this Keltner's theory or just a market rumor? I think Keltner believed it too. I borrowed $20,000 from my mother, added it to my $30,000, and bet everything on the blight. I bought the maximum number of corn and wheat contracts possible for $50,000 in margin. Initially, the markets held steady because there was enough fear of the blight to keep prices up. I wasn't making money, but I wasn't losing it either. Then one day I will never forget this. There was an article in the Wall Street 14 Journal with the headline, "More Blight on the Floor of the Chicago Board of Trade Than in Midwest Cornfields." He laughs. The corn market opened sharply lower and fairly quickly went limit down. High many futures markets. The maximum daily price change is restricted by a specified limit. Nowadays I try to avoid the currencies because I feel it is a totally political situation. You have to determine what the central banks are going to do. When you were trading the currencies actively, were you getting up through the night because you were worried about getting caught on the wrong side of a major move before the markets opened in the US? Yes. Did you always trade that way, or did you get caught enough times so that you started trading around the clock? It happened enough times to make me leery. There would be a big gap move that you could have avoided by trading overseas. That is right. For example, I remember one time, during late 1978, the dollar was getting battered, falling to new lows every day. This was during a period when I was cooperating and trading as a colleague with Brace Kovner. We used to talk hours every day. One day, we noticed that the dollar got mysteriously strong. There was an intense price movement that couldn't be explained by any known information. We just bailed out of our long currency positions like crazy. That weekend, President Carter announced a dollar support program. If we had waited until the next U.S. trading session, we would have been annihilated. That situation illustrates one of the principles we believed in, namely, that the big players, including the governments, would always tip their hand. If we saw a surprise price move against us that we didn't understand, we often got out and looked for the reason later. I remember that market well. The currency futures markets were locked limit down for several days in a row after that announcement. You must have gotten out right near the top of that market. We made a great exit on that trade. Anyway, my point is that I believe, as a courtesy, the European Central Banks are notified about major changes we are going to make, and they often act ahead of U.S. policy and announcements. Consequently, the price move shows up in Europe first, even if it is because of something we initiate. If it's an action initiated by the Europeans, the price move is certainly going to occur there first. I think the best hours to trade are often in Europe. If I had a period in which I was going to devote my life to trading, I would want to live in Europe. Let's go back and fill in some of your trading history. Where did you go after you decided to give up on being a floor trader? I got a call from Amos Hostetter, who had befriended me at Sherson. At the time, he was also trading some money for Commodities Corporation. Amos told me that I would be well advised to consider joining Commodities Corporation as a trader. At the time, their theory was that they were going to hire all these great econometricians to be traders. They had people like Paul Samuelson on the board. They brought up the idea of hiring me at a meeting. The first question was, what articles has he written? In what journals has he been published? I had a B.A. in liberal arts, and that was it. The punchline was, he just trades. Everybody thought that was very funny. But weren't they in business to make money trading? They didn't think it was possible to really make money unless you had a Ph.D., but Amos convinced them to give me a chance. I believe I was the first non-Ph.D. trader they had ever hired. They started me out with $30,000 in August 1974. After about 10 years, I had turned that account into $80 million. Those were some very good years. Did you multiply the original $30,000 into $80 million, or did they add money along the way? After the first few years, they gave me another $100,000 to trade. After that time, they were always taking money out. In those years, they were in an expansionary phase, and they taxed the traders 30% a year to pay for their expenses. So you had to make 30% a year to keep your account level. You must have had some incredible return years, given the growth of your account, particularly under that handicap. I was making at least 100% a year for years and years. What was your best year? My best year must have been 1979. It was an incredible year. I caught gold when it went up to over $800. You caught the whole move. I was in and out, but I remember catching big chunks of it, $100 per ounce at a time. It was a wild time. And those days I would buy gold in Australia. Hong Kong would push it up $10 higher, it would go up another $10 in London, and by the time New York opened, I was able to sell out at a $30 profit. It sounds like there was an enormous advantage to buying gold in the overseas markets rather than in the United States. In those days, I had an advantage by being in California because I was up trading in Hong Kong when my New York colleagues were asleep. I remember when I heard about the invasion of Afghanistan on the television news. I called Hong Kong to see if anybody knew about it, and nobody seemed to. The price wasn't changing. I was able to buy 200,000 ounces of gold before anybody knew what was happening. That's 2,000 contracts. Did you have any liquidity problems with their taking on that size position? In Haba. No, they gave me the stuff, but of course they got fried by doing it. I was told on my last visit to Hong Kong, 20, that I shouldn't visit the gold floor. Some of the people still remember that episode. They knew who was on the other side of the trade. Yes, they knew. Did they think that you knew something? No, they probably thought I was just crazy, coming in and buying all that gold. Then, when the news broke, about 5 to 10 minutes later, everybody started scrambling. I had an immediate $10 per ounce profit on 200,000 ounces. It's hard to believe you could trade off the television news. I know. I had never done it before. That was the first, last, and only time, but I did do it. That particular gold market ended in a near vertical rise and fall. Did you get out in time? Yes, I got out around $750 on the way up. I felt sick when I saw gold go up to nearly $900. But later when it was back down to $4,001, felt much better about it. All in all, you got out very well. What tipped you off that we were near a top? At that time, we had many wild markets. One of my rails was to get out when the volatility and the momentum became absolutely insane. One way I had of measuring that was with limit days. In those days, we used to have a lot of situations when a market would go limit up for a number of consecutive days. On the third straight limit up day, I would begin to be very, very cautious. I would almost always get out on the fourth limit up day. And if I had somehow survived with any part of my position that long, I had a mandatory rail to get out on the fifth limit up day. I just forced myself out of the market on that kind of volatility. Your transition from being a losing trader to being very successful coincided with the big bull phase in the commodity markets during the early to mid-1970s. How much of your early success was due to your skills as a trader, and how much was just the markets? Honestly, I think the markets were so good that by buying and holding you just couldn't lose. There were a lot of other success stories. Fortunes were being made. But a lot of those people didn't keep their fortunes. That's true. But I was very fortunate. By the time the markets got difficult again, I was a good trader. But then I had really learned my craft. Also, by that time, I had the advantage of having become very knowledgeable in one market, cocoa. For almost 2 years, I traded almost nothing but cocoa, because of the information and help I got from Helmut Weimer, the founder of Commodities Corporation. Helmut was an incredible expert on cocoa. He wrote a book that was so deep I couldn't understand the cover. Also, he had all kinds of friends in the business. With the knowledge and information I got from Helmut and his friends, I felt that I knew the universe of cocoa in a way that I had never known any market before. That phase of almost exclusive cocoa trading obviously came to an end. What happened? Helmut retired from cocoa trading. I assume Helmut was not nearly as successful a trader as you are. Let's just say that I traded much better on Helmut's information than he did. Excluding the early losing years, were there any trades that stand out as being particularly traumatic? Well, I would never let myself get caught up in potentially intimidating disasters. The worst situation occurred during my heavy currency trading period. I was doing well and could afford to hold large positions. One time I had a really large position in Deutschmarks when the Bundesbank came in and decided to punish the speculators. I called in just around the time that all this was happening and found out that I was out $2 million in about 5 minutes. So I got out rather than see the $2 million loss go to $10 million. Then I had to endure the disturbing experience of watching the market recover its entire fall. How long after you got out? About half an hour. Did you go back in? No, they had taken the starch out of me by that point. In retrospect, do you feel you did the right thing by getting out of that trade? Yes, but it still hurt to realize that if I had sat it out and done nothing, I would have been okay instead of losing $2 million. Did you invest any of the money you were making in your trading, or did you keep plowing it back into your own account? I made a number of bad investments and lost a fairly large chunk of the money I had made trading. When I was trading big, I wanted to have a reason to keep doing it, so I just spent money wildly. At one time, I owned about 10 houses and ended up losing money on all of them. Some I sold before I had even spent a single night in them. I had a plane charter service and lost a lot of money on that. At one point, I figured out that for every dollar I made, trading 30% was going to the government, 30% was going to support my planes, and 20% was going to support my real estate. So I finally decided to sell everything. It sounds like, as wise as you were as a trader, you were naive as an investor. Yes, I was incredibly naive. Out of a fairly large number of real estate transactions, many in California, I lost money on all but one of them. I am probably the only person alive that can claim that dubious distinction. 21. Why do you think you did so poorly on your investments? I would do everything emotionally. I didn't analyze anything. In a sense, you were repeating the mistake of your early trading experience, getting involved in something you knew nothing about and then losing money. Didn't any bells go off? It almost sounds like you had a self-destructive instinct in losing your money elsewhere. Yes, absolutely. I probably lost more than half the money I made. During this period, when you were doing all these unwise things, didn't anybody try to grab you by the shoulders and say, "Do you realize what you're doing?" Yes, but any time someone on my staff did, I would fire them. At one time, I was employing 60 or 70 people. High addition to all my money-losing businesses, I had a huge nut to make to just support the payroll. Frankly, a lot of the money I made just went down the drain. Did these losses have any of the emotional impact of losses in the market? The reason I ask is that you seem to talk about these investment losses very dispassionately. Yes, it hurt to realize what a fool I had been, but I have learned not to be as attached to material things. I accepted it as a life lesson. I learned I don't have to own a house in every beautiful place in the world. I can stay at a hotel and walk on the beach or climb a trail there. Or if I really feel like spoiling myself, I can charter a plane. I don't have to own one. Right, that certainly makes sense, but what I am getting at is that I suspect that if you had lost the same amount of money trading, it would have been a much more traumatic experience. Is that because your ego wasn't attached to these other ventures? Yes, I'm sure that's true. I always felt that at least I was smart at one thing. I feel like trading is the only thing I am really good at. If not for that, I probably would have wound up shining shoes. Do you think being a great trader is an innate skill? I think to be in the upper echelon of successful traders requires an innate skill, a gift. It's just like being a great violinist. But to be a competent trader and make money is a skill you can learn. Having been through the whole trading experience from failure to extreme success, what basic advice could you give a beginning trader or a losing trader? The first thing I would say is always bet less than 5% of your money on any one idea. That way you can be wrong more than 20 times. It will take you a long time to lose your money. I would emphasize that the 5% applies to one idea. If you take a long position in two different related grain markets, that is still one idea. The next thing I would advise is to always use stops. I mean actually put them in, because that commits you to get out at a certain point. Do you always pick a point where you will get out before you get in? Yes, I have always done that. You have to. I would imagine in your case you can't actually put a stop in because your orders are too large. Yes, but my broker can hold it. When you place an order to get into a position, is it accompanied by an order to get out? That's right. Another thing is that if a position doesn't feel right as soon as you put it on, don't be embarrassed to change your mind and get right out. So if you put the trade on and 5 minutes later it doesn't feel right, don't think to yourself, if I get out this quickly, my broker will think that I'm an idiot. Yes, exactly. If you become unsure about a position and you don't know what to do, just get out. You can always come back in. When in doubt, get out and get a good night's sleep. I've done that lots of times, and the next day everything was clear. Do you sometimes go back in right after you get out? Yes, often the next day. While you are in, you can't think. When you get out, then you can think clearly again. What other advice would you give the novice trader? Perhaps the most important rule is to hold on to your winners and cut your losers. Both are equally important. If you don't stay with your winners, you are not going to be able to pay for the losers. You also have to follow your own light. Because I have so many friends who are talented traders, I often have to remind myself that if I try to trade their way or on their ideas, I am going to lose. Every trader has strengths and weaknesses. Some are good holders of winners, but may hold their losers a little too long. Others may cut their winners a little short, but are quick to take their losses. As long as you stick to your own style, you get the good end, bad in your own approach. When you try to incorporate someone else's style, you often wind up with the worst of both styles. I've done that a lot. Is it a problem because you don't have the same type of confidence in a trade that isn't yours? Exactly how the final analysis, you need to have the courage to hold the position and take the risk. If it comes down to I'm in this trade because Brace is in it, then you are not going to have the courage to stick with it. So you might as well not be in it in the first place. Do you still talk to other traders about markets? Not too much. Over the years, it has mostly cost me money. When I talk to other traders, I try to keep very conscious of the idea that I have to listen to myself. I try to take their information without getting overly influenced. 22. By their opinion. I assume that we are talking about very talented traders, and it still doesn't make a difference. If it is not your own idea, it messes up your trading. Right. You need to be aware that the world is very sophisticated, and always ask yourself how many people are left to act on this particular idea. You have to consider whether the market has already discounted your idea. How can you possibly evaluate that? By using the classic momentum type indicators and observing market tone. How many days has the market been down or up in a row? What is the reading on the sentiment indexes? Can you think of any good examples of market tone tipping you off on a trade? The most classic illustration I can think of is one of the soybean bull markets in the late 1970s. At the time, soybeans were in extreme shortage. One of the things pushing the market up was the weekly government reports, indicating strong export commitments and sales. I was holding a heavy long position in soybeans, and someone from Commodities Corporation called me with the latest export figures. He said, "I have good news and I have bad news." I said, "Okay, what is the good news?" "The good news is that the export commitment figure was fantastic." "The bad news is that you don't have a limit position, the maximum permissible speculative position size." They were expecting the market to be limit up for the next 3 days. Actually, I wound up being a little depressed that I didn't have a larger position. The next morning I entered and ordered to buy some more contracts on the opening, just in case I got lucky and the market traded before locking. Limit up. I sat back to watch the fun. The market opened limit up as expected. Shortly after the opening I noticed a lot of ticks being recorded, as if the market was trading at the limit up. Then prices eased off limit up just as my broker called to report my fills. The market started trading down. I said to myself, soybeans were supposed to be limit up for 3 days, and they can't even hold limit up the first morning. I immediately called my broker and frantically told him to sell, sell, sell. "Did you get out of your whole position?" Not only that, but I was so excited that I lost count of how much I was selling. I accidentally wound up being short a substantial amount of soybeans, which I bought back 40 to 50 cents lower. That was the only time I made a lot of money on an error. I remember a situation just like that. It was the cotton bull market, when prices almost reached $1 a pound. To this day, I recall I was long cotton and the week's export figure came out showing 500,000 bales of exports to China. It was the most bullish cotton export figure I had ever seen. But instead of opening limit up, the next day the market opened only about 150 points higher and then started trading off. That proved to be the exact high. Another interesting example, I remember, occurred when we were in a very inflationary period and all the commodity markets were trading in lockstep fashion. On one particularly powerful day, almost all the markets went limit up. On that day, cotton opened limit up, fell back, and finished only marginally higher for the day. That was the market peak. Everything else stayed locked limit up, but cotton never saw the light of day again. Is the implied rule that if you find a common behavior between markets, you want to sell the one that is lagging as soon as it starts heading down? You absolutely want to put down a bet when a market acts terribly relative to everything else. When the news is wonderful and a market can't go up, then you want to be sure to be short. What kinds of misconceptions about the markets get people into trouble? Well, I think the leading cause of financial disablement is the belief that you can rely on the experts to help you. It might, if you know the right expert. For example, if you happen to be Paul Tudor Jones' barber, and he is, talking about the market, it might not be a bad idea to listen. Typically, however, these so-called experts are not traders. Your average broker couldn't be a trader in a million years. More money is lost listening to brokers than any other way. Trading requires an intense personal involvement. You have to do your own homework, and that is what I advise people to do. Any other misconceptions? The foolish belief that there is conspiracy in the markets. I have known many of the great traders in the world, and I can say that 99% of the time the market is bigger than anybody, and sooner or later it goes where it wants to go. There are exceptions, but they don't last too long. You have attributed a lot of your success to Ed and Amos, who taught you the principles of trading. Have you, in turn, taught other traders? Yes. My best result, in terms of his becoming the best trader I ever worked with, as well as being a close friend is Bruce Kovner. How much of his success do you attribute to your training, and how much of it was just his own talent? When I first met Bruce, he was a writer and a professor. In his spare time he was doing some trading. I was staggered by the breadth of trading knowledge he had accumulated in such a short time. I remember the first day I met Bruce, I tried to impress him with complicated concepts. Here I was, a professional trader who, in those days, spent 15 hours a day trading and analyzing the markets, and I couldn't come up with anything that he couldn't understand. I recognized his talent immediately. That relates to his intellect, but was there something about him that told you that he was going to be a good trader? Yes, his objectivity. A good trader can't be rigid. If you can find somebody who is really open to seeing 23 anything, then you have found the raw ingredient of a good trader, and I saw that in Bruce right away. I knew from the moment I first met him that he was going to be a great trader. What I tried to do was convey to Brace the principles that Ed and Amos had taught me, along with some of my acquired skills. My best trading occurred when Brace and I were collaborating. We did some phenomenal trading. There were years when I was up 300% and he was up 1000%. He had a very great gift. Do you feel you get ground down as a trader? Absolutely. Around 19,831 began to taper off in my trading. I felt that I needed to recharge my batteries. How important is gut feel in trading? Gut feel is very important. I don't know of any great professional trader that doesn't have it. Being a successful trader also takes courage, the courage to try, the courage to fail, the courage to succeed, and the courage to keep on going when the going gets tough. Do you have any goals aside from trading at this point? I have taken karate for many years. I'm already at a high level, but I would like to get the black belt. Also, I have made a study of spiritual traditions, and there is a bit more work I would like to do with that. You sound very vague about it. Do you want to be vague? It is very hard to talk about this. Let me see how I can put it. Albert Einstein said that the single most important question is whether the universe is friendly. I think it is important for everybody to come to a point where they feel inside that the universe is friendly. Are you there now? I'm a lot closer. But that's not where you started off. No, I started off with the feeling that it was an unfriendly place. Do you see yourself trading 10 or 20 years from now? Yes, it's too much fun to give up. I don't want to make a lot more money. I would probably just end up losing it in real estate again. Is the fun aspect still there if you are doing it 13 hours a day? No. If trading is your life, it is a torturous kind of excitement. But if you are keeping your life in balance, then it is fun. All the successful traders I've seen that lasted in the business sooner or later got to that point. They have a balanced life. They have fun outside of trading. You can't sustain it if you don't have some other focus. Eventually, you wind up overtrading or getting excessively disturbed about temporary failures. When you do hit a losing streak, how do you handle it? In the past, I've sometimes tried to fight back by trading even heavier after I start losing, but that usually doesn't work. Then I start cutting down very fast to the point of stopping completely if it gets bad enough. But usually it never gets that bad. Do you sometimes manage to fight your way out of it? Sometimes, but most of the time I would have been better off if I had just stopped. I've had trouble bringing myself to do that because I am a natural fighter. The typical pattern is lose, fight like hell, lose again, then cut back, or sometimes stop until I get on a winning track. How long have you stopped for? Usually 3, 4 weeks. When you are in a losing streak, is it because you are out of sync with the markets, or is there a better way to describe it? I think that in the end, losing begets losing. When you start losing, it touches off negative elements in your psychology. It leads to pessimism. There are very few traders who have been as successful as you. What do you think makes you different? I am very open-minded. I am willing to take in information that is difficult to accept emotionally, but which I still recognize to be true. For example, I have seen others make money much faster than I have, only to wind up giving everything back because when they started losing, they couldn't stop. When I have had a bad losing streak, I have been able to say to myself, you just can't trade anymore. When a market moves counter to my expectations, I have always been able to say, I had hoped to make a lot of money in this position, but it isn't working, so I'm getting out. Do you keep track of your equity on a day-to-day basis? Do you actually plot it? I have done that a lot in the past. Is that helpful? Do you think it's a good idea for traders to plot their equity? I think so. If the trend in your equity is down, that is a sign to cut back and reevaluate. Or if you see that you are losing money a lot faster than you made it, that would be a warning. Are there any advisors you pay attention to? My favorite market letter in terms of readability, imagination, and knowledge of the subject is the California Technology Stock Letter, CTSL Publishing Partners, 155 Montgomery Street, Suite 1401, San Francisco, CA 94104. I also like the market letters put out by Marty Swade, the Swade Letter, the Swade Forecast, P.O. Box 360, Belmore, NY, 24 11710, and Richard Russell Dow Theory Letters, Inc., P.O. Box 1759, La Jolla, CA 90 2038. Of the traders I have interviewed, Swade is probably the one most mentioned. You always get something of value out of Marty Swade. He is very solid. Judging by the letters you have mentioned, I take it that you trade stocks as well. How long have you been trading stocks? For about the last 2 years. Do you trade stocks differently than you trade futures? I'm more patient. Is the selection process different? No, I look for confirmation from the chart, the fundamentals, and the market action. I think you can trade anything in the world that way. Do you focus on any particular types of stock? I don't trade the Dow stocks. I prefer the little ones because they are not dominated by the big professional traders who are like sharks eating each other. The basic principle is that it is better to trade the Australian dollar than the Deutschmark and the small OTC stock than the big Dow stock. What are the fundamentals you look for in a stock? I like to use something I found in Investors Daily, the earnings per share EPS. The EPS ranking is based on comparing the earnings per share growth of a stock relative to all other stocks. For more details on the EPS, see the William O'Neill and David Ryan interviews. I combine the EPS with my own sense of market share potential. If a company has already saturated their little niche in the world, a high EPS is not that important. But in those issues where the EPS is growing and there is still plenty of pie out there, the situation is much more attractive. I also like to look at the price-earnings P ratio in conjunction with the EPS. Other words, while I like to see a company with a strong earnings growth pattern, I also want to know how much the market is paying for that earnings growth pattern. So you like seeing a high EPS with a low PE? Yes, that's the best combination. I am sure there is a way of combining the two on a computer and coming up with a very good system out about the relative strength and measure of a stock's price performance relative to all other stocks, which is another key indicator in Investors Daily. I don't think that helps that much. Relative strength tells you what a stock has already done. Frequently, by the time you get a high relative strength figure, the stock has exhausted itself. Is there anything else you look for in a stock? I look at the basic industry. For example, right now, May 1988, I happen to be bullish on tanker rates and, therefore, the shipping business. For what reasons? Supply and demand. Tanker rates are like commodity prices. They follow a classic cyclical pattern. Prices get high and everyone makes a lot of money, so they build a lot of ships and prices go down. Eventually the ships are scrapped and prices go back up again. We have had very low rates for many years and have scrapped a lot of tankers annually. So we are entering that part of the cycle where prices go back up again. Does trading become more difficult as the size of the account gets bigger? Yes, because you are forced to compete in fewer and fewer markets that are being traded by other big professionals. How much common behavior is there between different markets? For example, can you trade bonds in the same way you trade corn? I really feel that if you can trade one market, you can trade them all. The principles are the same. Trading is emotion. It is mass psychology, greed, and fear. It is all the same in every situation. For most great traders, early failure is more the rule than the exception. Despite an incredible long-term performance record, Michael Marcus began his trading career with an unbroken string of trading losses. Moreover, he wiped out not just once, but several times. The moral is early trading failure is a sign that you are doing something wrong. It is not necessarily a good predictor of ultimate potential failure or success. I found it particularly interesting that, despite a number of painful trading losses, Marcus' most devastating experience was actually a profitable trade in which he got out prematurely, taking advantage of potential major winning trades is not only important to the mental health of the trader, but is also critical to winning. In the interview, Marcus stressed that letting winners ride is every bit as important as cutting losses short. In his own words, if you don't stay with your winners, you are not going to be able to pay for the losers. Marcus learned about the dangers of overtrading the hard way. In one instance, the grain trade in the non-existent corn blight year, an account he had built up from a very small stake to $30,000 was wiped out by betting all his money on a single trade. He made the same mistake a second time in the lumber market, coming to the brink of disaster before narrowly escaping. These experiences had a dramatic impact on Marcus' trading philosophy. It is no accident that the first rule he cites when asked to give advice to the average trader is never commit more than 5% of your money to a single trade idea. In addition to not overtrading, Marcus stresses the importance of committing to an exit point on every trade. He feels that protective stops are very important because they force this commitment on the trader. He also recommends liquidating positions to achieve mental clarity when one is losing money and is confused regarding 25 market decisions. Marcus also emphasizes the necessity of following your own mind as a trader. He suggests that following the advice of others, even when they are good traders, often leads to problems as it combines the worst elements of both traders. Finally, despite being an aggressive trader, Marcus strongly believes in being restrictive in selecting trades. He advises waiting for those trades in which all the key elements line up in one direction. By doing so, you greatly enhance the probability of success on each trade. Making lots of trades when the conditions appear to be only marginally in favor of the trade idea has more to do with entertainment than trading success. 26. Bruce Kovner, the world trader. Today, Bruce Kovner may well be the world's largest trader in the interbank currency and futures markets. In 1987 alone, he scored profits in excess of $300 million for himself and the fortunate investors in his funds. During the past 10 years, Kovner has realized a remarkable 87% averaged annual compounded return. $2,000 invested with Kovner in early 1978 would have been worth over $1 million 10 years later. Despite his incredible track record and huge trading size, Kovner has managed to keep a surprisingly low profile. He has assiduously pursued his privacy by steadfastly refusing all interview requests. "You might be wondering why I consented to this interview," he said. "As a matter of fact, I was, but I did not want to raise the question." I had assumed that his agreement reflected a vote of confidence and trust. 7 years earlier our paths had crossed briefly when we both worked at Commodities Corporation, he as one of the firm's principal traders, I as an analyst. Kovner continued, "It seems like I can't avoid some publicity, and the stories are usually distorted and fanciful. I thought that this interview would help establish at least one accurate record." Kovner hardly fits the intuitive image of a trader who typically holds positions with a total face value measured in billions of dollars. With his incisive intellect and easygoing manner, he reminds one more of a professor than a giant-scale trader in the highly leveraged currency and futures markets. Indeed, Kovner started out as an academic. After graduating from Harvard, Kovner taught political science courses at Harvard and the University of Pennsylvania. Although he liked teaching, he was not enthused with the academic life. "I didn't enjoy the process of always confronting a blank page in the morning and thinking of something brilliant to write." In the early 1970s, Kovner managed a number of political campaigns with the idea of eventually running for office himself. He abandoned politics because he didn't have the financial resources or the desire to work his way up the political ladder from committee jobs. During this time, he also worked as a consultant for various state and federal agencies. Still searching for a career direction, Kovner shifted his attention to the financial markets in the mid-1970s. He believed that his economics and political science education provided the right background, and he found the idea of analyzing the world to make trading judgments tremendously appealing. For about a year, Kovner immersed himself in studying markets and the related economic theory. He read everything he could get his hands on. One subject he studied intensively was interest rate theory. "I fell in love with yield curve." The yield curve is the relationship between the yield on government securities and their time to maturity. For example, if each successively longer term maturity provided a higher yield than a shorter term maturity, for example, 5-year T notes at a higher yield than 1-year T-bills, the yield curve would reflect a continually rising slope on a graph. Kovner's study of the interest rate markets coincided with the initial years of trading in interest rate futures. At that time, the interest rate futures market was relatively unsophisticated, and price distortions, which would be quickly eradicated by arbitrageurs today, persisted over time. As Kovner explains it, the market hadn't become important enough for Citibank or Salomon Brothers, but it was important enough for me. One of the primary anomalies Kovner discovered was related to the price spread difference between Different futures contracts. Futures are traded for specific months, for example, March, June, September, and December. Given the prevailing phase of the business cycle, interest rate theory predicted that the nearby contract, for example, March, should trade at a higher price, lower yield than the next contract, for example, June, although the nearest two contracts did indeed tend to reflect this relationship. Kovner found that the price difference between more forward contracts often started trading at near zero levels. His first trade involved buying a forward interest rate contract and selling a more forward contract in the expectation that as the purchased contract became the nearby contract with the passage of time, the price spread between the two contracts would widen. That first trade worked just according to textbook theory, and Kovner was hooked as a trader. His second trade also involved an intra-market spread, the purchase of one contract against the sale of another contract in that same market. In this case, he bought the nearby copper contract and sold a more forward contract in the expectation that supply tightness would cause the nearby copper contract to gain relative to the forward position. Although his idea eventually proved right, he was too early and lost money on that trade. At the end of these two trades, Kovner was still ahead, with his original $3,000 stake having grown to about $4,000. My third trade is what really put me in the business. In early 1977, an apparent shortage was developing in the soybean market. It was a demand-driven market. Every week the crush was higher than expected, and nobody believed the figures. The crush is the amount of soybeans processed for use as soybean meal and soybean oil. I was watching the July-November spread, the price difference between the old crop July contract and the new crop November contract. Since it looked like we were going to run out of soybeans, I thought that the old crop July contract would expand its premium to the new crop November contract. This spread had been trading in a narrow consolidation near 60 cents premium July. I figured I could easily stop myself out just below the consolidation at around a 45 cents premium. At the time, I didn't realize how volatile the spread could be. I put on one spread that is bought July soybeans and simultaneously sold November soybeans near 60 cents, and it widened to 70 cents. Then I put on another spread. I kept on pyramiding. How big of a position did you build up? I eventually built up to a position of about 15 contracts, but not before I had to switch brokerage firms. When I started out, I was trading at a small brokerage house. A head of the company, who was an old floor trader, went over the trades every day and spotted what I was doing. By that time, I had built my position up to about 10 or 15 contracts. The margin on a single outright contract was $2,000, while the spread margin was only $400. He told me, "The spread position you have on trades like an outright long position. I am going to raise your margins from $400 to $2,000 per contract." Spread margins are lower than outright margins, reflecting the assumption that a net long or short position will be considerably more volatile than a spread position. Reason in a spread, the long contract portion of the position is likely to at least partially offset price movement in the short. 27. Contract position. In a shortage situation, however, an intercrop spread, such as long July soybeans, short November soybeans, can prove to be nearly as volatile as a net long or short position. He was obviously quite concerned with the risk in your position. Yes, he was concerned that I had only put up $400 margin per spread on a spread which behaved like a net long position. Actually, he wasn't that far off. He was right, but I was furious. So I moved my account to another brokerage firm, which shall remain aimless for reasons that will soon become clear. You were furious because you felt he was being unfair, or, well, I am not sure I thought he was being unfair, but I certainly knew he was an obstacle to my objective. I moved my account to a major brokerage house and got a broker who was not very competent. The market kept moving up and I kept adding to my position. I had put on my first spread on February 25. By April 12, my account was up to $35,000. Were you just adding to your position as the market went up, or did you have some plan? I had a plan. I would wait until the market moved up to a certain level and then retraced by a specified amount before adding another unit. My pyramiding did not turn out to be the problem. The market had entered a string of limit-up moves. On April 13, the market hit a new record high. The commotion was tremendous. My broker called me at home and said, "Soybeans are going to the moon. It looks like July is going limit up and November is sure to follow. You are a fool to stay short the November contracts. Let me lift your November shorts for you, and when the market goes limit up for the next few days, you will make more money." I agreed, and we covered my November short position. All of it, all of it, he laughs loudly. Was this a spur-of-the-moment decision? It was a moment of insanity. 15 minutes later, my broker calls me back, and he sounds frantic. "I don't know how to tell you this, but the market is limit down. I don't know if I can get you out." I went into shock. I yelled at him to get me out. The market moved off of limit down by a little bit, and I got out. Did you end up getting out at limit down? I got out between limit down and slightly above limit down. I can tell you the dimensions of the loss. At the moment I covered my short November position, leaving myself net long July, I was up about $45,000. By the end of the day, I had $22,000 in my account. I went into emotional shock. I could not believe how stupid I had been, how badly I had failed to understand the market, in spite of having studied the markets for years. I was sick to my stomach, and I didn't eat for days. I thought that I had blown my career as a trader, but you still had $22,000 compared to your original stake of only $3,000. Keeping things in perspective, you were still in pretty good shape. Absolutely. I was in good shape, but was it the stupidity of the mistake, or was it the money that you had given back that caused such emotional pain? No, it wasn't the money at all. I think it was the realization that there really was fire there. Until then I had ridden $3,000 to $45,000 without a moment of pain. On the way up, did you think, "This is easy"? It was easy. Did you give any thought to the possibility that the market street could eventually go the other way? No, but clearly my decision to lift the short side of my spread position in the middle of a panic showed a complete disregard for risk. I think what bothered me so much was the realization that I had lost a process of rationality that I thought I had. At that moment, I realized that the markets were truly capable of taking money away, every bit as fast as they gave it to you. That made a very strong impression on me. Actually, I was very lucky to get out with $22,000. I assume that your quick action that day probably averted a complete disaster. Absolutely. After that day, the market went straight down as fast as it had gone up. Perhaps if I hadn't made my stupid mistake, I might have made the mistake of writing the market down. What eventually happened to the spread? The spread collapsed. Eventually, it went below the level that I had first begun buying it at. Since you liquidated your position on the day the market and the spread topped, you would have given back a portion of the profits even if it wasn't for the disastrous decision that forced you out of the market. That may be true, but for me, that was my going bust trade. It was the closest I ever came to going bust, and psychologically it felt as if I had. Was that your most painful trade? Yes, far and away. 28. Even though you actually ended up making a substantial amount of money on the trade. I multiplied my money by nearly sixfold on that trade. I was, of course, insanely leveraged, and I didn't understand how risky my position was getting out of your entire position immediately after your broker called to tell you the market was limit down a matter of panic, or do you think you had some instinctive common sense about controlling risk? I'm not sure. At that moment, I was confronted with the realization that I had blown a great deal of what I thought I knew about discipline. To this day, when something happens to disturb my emotional equilibrium and my sense of what the world is like, I close out all positions related to that event. Do you have a recent example? October 190, 1987, the week of the stock market crash. I closed out all my positions on October 19 and 20 because I felt there was something happening in the world that I didn't understand. The first rule of trading there are probably many first rails is don't get caught in a situation in which you can lose a great deal of money for reasons you don't understand. Let's get back to the period after your soybean trade. When did you start trading again? About a month later. After a few months, I had my account back to about $40,000. Around that time, I answered an ad for a trading assistant position at Commodities Corporation. I was interviewed by Michael Marcus in his usual idiosyncratic manner. He had me return to Commodities Corporation several weeks later. Well, he said, I have some good news and some bad news. The bad news is that we are not hiring you as a trading assistant. The good news is that we are hiring you as a trader. How much money did Commodities Corporation give you to trade? $35,000. Were you trading your own money as well at the same time? Yes, and that is something I am very glad about. Commodities Corporation had a policy that allowed you to trade your personal account as well as the company account, and Michael and I were very aggressive traders. Were you influenced by Michael? Oh, yes, very much. Michael taught me one thing that was incredibly important. Pause. That is a great lead in. What is the punch line? He taught me that you could make $1,000,000. He showed me that if you applied yourself, great things could happen. It is very easy to miss the point that you really can do it. He showed me that if you take a position and use discipline, you can actually make it. It sounds like he gave you confidence. Right. He also taught me one other thing that is absolutely critical. You have to be willing to make mistakes. Regularly, there is nothing wrong with it. Michael taught me about making your best judgment, being wrong, making your next best judgment, being wrong, making your third best judgment, and then doubling your money. You are one of the most successful traders in the world. There are only a small number of traders of your caliber. What makes you different from the average guy? I'm not sure one can really define why some traders make it while others do not. For myself, I can think of two important elements. First, I have the ability to imagine configurations of the world different from today and really believe it can happen. I can imagine that soybean prices can double or that the dollar can fall to 100 yen. Second, I stay rational and disciplined under pressure. Can trading skills be taught? Only to a limited extent. Over the years, I'd have tried to train perhaps 30 people, and only 4 or 5 of those have turned out to be good traders. What happened to the other 25? They are out of the business, and it had nothing to do with intelligence. When you compare the trainees that made it to the majority that did not, do you find any distinguishing traits? They are strong, independent, and contrary in the extreme. They are able to take positions others are unwilling to take. They are disciplined enough to take the right size positions. A greedy trader always blows out. I know some really inspired traders who never managed to keep the money they made. One trader at Commodities Corporation, I don't want to mention his name, always struck me as a brilliant trader. The ideas he came up with were wonderful. The markets he picked were often the right markets. Intellectually, he knew markets much better than I did, yet I was keeping money and he was not. So where was he going wrong? Position size. He traded much too big. For every 1 contract I traded, he traded 10. He would double his money on 2 different occasions each year, but still end up flat. Do you always use fundamental analysis in forming your trading decisions? I almost always trade on a market view. I don't trade simply on technical information. I use technical analysis a great deal, and it is terrific, but I can't hold a position unless I understand why the market should move. Is that to say that virtually every position you take has a fundamental reason behind it? I think that is a fair statement, but I would add that technical analysis can often clarify the fundamental. 29. Picture. I will give you an example. During the past 6 months, I had good arguments for the Canadian dollar going down and good arguments for the Canadian dollar going up. It was unclear to me which interpretation was correct. If you had put a gun to my head and forced me to choose a market direction, I probably would have said down. Then the U.S. Canadian trade pact was announced, which changed the entire picture. High fact, the market had broken out on the upside a few days earlier as the negotiations were finishing up. At that instant, I felt completely comfortable saying that one of the major pieces Roman II, the valuation of the Canadian dollar, had just changed, and that Marlott had already voted. Prior to the agreement, I felt the Canadian dollar was at the top of a hill, and I wasn't sure whether it was going to roll backwards or forwards. When the market moved, I was prepared to go with TLAT movement because we had a conjunction of 2 important elements, a major change in fundamentals, although I wasn't smart enough to know in which direction it would impact the market, and a technical price breakout on the upside. What do you mean you weren't smart enough to know in which direction the trade pact announcement would move the market, since U.S.-Canadian trade is so much a larger component of Canadian trade than it is of U.S. trade? Wouldn't it have been logical to assume that the trade pact would be bullish for the Canadian dollar? It didn't have to happen that way. I could just as easily have aided that the trade pact was negative for the Canadian dollar because elimination of the trade barriers would allow imports from the to submerge Canadian interests. There are still some analysts who adhere to that argument. My point is that there are well-informed trailers who know much more than I do. I simply put things together. They knew which way to go, and they voted in the marketplace by buying Canadian dollars. Is the generalization of that example that when an important fundamental development occurs, the initial direction of the Marlott move is often a good tip-off of the longer-term trend? Exactly. The market usually leads because there are people who know more than you do. For example, that Soviet Union is a very gawked trader. Good trader in which markets? In currencies and grains to some degree. How does one know what the Soviets are doing? Because the Soviets act through commercial banks and dealers, and you hear about it. It seems rather contradictory to me that a country that is so poor in running its own economy should be a good trader. Yes, but if you ask people in the business, you will find out that they are. Why or how? It is a joke, but perhaps they do read some of our mail. The Soviets and other governments occasionally have advance information. Why shouldn't they have the best developed intelligence service in the world? It is a well-known fact in the intelligence community that the Soviets and others are capable of eavesdropping on commercial communication. That is why the large commodity trading firms sometimes use scramblers when they are making very sensitive calls. My point is that there are thousands of difficult to understand mechanisms that lead the market, which come into play before the news reaches some poor trader sitting at his desk. But the one thing that does hit the market is a huge sale or purchase. Isn't that the basic rationalization for technical analysis? Technical analysis, I think, has a great deal that is right and a great deal that is mumbo-jumbo. That's an interesting statement. What's right and what's black magic? There is a great deal of hype attached to technical analysis by some technicians who claim that it predicts the future. Technical analysis tracks the past. It does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. For me, technical analysis is like a thermometer. Fundamentalists who say they are not going to pay any attention to the charts are like a doctor who says he's not going to take a patient's temperature. But, of course, that would be sheer folly. If you are a responsible participant in the market, you always want to know where the market is, whether it is hot and excitable or cold and stagnant. You want to know everything you can about the market to give you an edge. Technical analysis reflects the vote of the entire marketplace and therefore does pick up unusual behavior. By definition, anything that creates a new chart pattern is something unusual. It is very important for me to study the details of price action to see if I can observe something about how everybody is voting. Studying the charts is absolutely crucial and alerts me to existing disequilibria and potential changes. Do you sometimes put on a trade because you look at a chart and say, "I've seen this pattern before," and it is often a forerunner of a market advance? That is, even though you may not have any fundamental reasons. Yes, I will do that sometimes. I would only add that, as a trader who has seen a great deal and been in a lot of markets, there is nothing disconcerting to me about a price move out of a trading range that nobody understands. Does that imply you usually go with breakouts? But the markets are often prone to false breakouts. There has to be more to it than that. Tight congestions in which a breakout occurs for reasons that nobody understands are usually good. 30.